Joining us in studio for our weekly strategy session is Vaughan Henkel, strategist at RMB Morgan Stanley. Vaughan, thanks so much for joining us this afternoon. Well, the last time you were here, we looked at your South African strategy, and at the top of it, I mean, you were differing from consensus on, a few key themes for the 2012 period. At the top of it, you expected the upper decile consumer to be negatively impacted by low income growth on the one hand and inflation on the other.
Agreed, yeah.
What are you making of the kind of retail figures we're continuing to see come through and the kind of recovery we're seeing in the South African economy that's largely based on a consumer recovery?
I mean, obviously, from our viewpoint, we've seen the end of those tailwinds. So, the upper end consumer we still believe is going to see difficulties as we unfold this year. What we saw with that is that if you go back the last 5 years, you had a huge tailwind, you had huge real wage growth. In fact, what we were having a look at more recently is that government wage growth in the past 3-4 years, 2009 was 31%, then 15, and then sort of 15 odd percent. So the tailwind that we saw in the past was actually more significant than even we expected. Now, if you go forward, the reason why we're calling for that, and obviously the retail figures were pretty okay for this December season, but the reason why we're looking for it is that going forward, government's about 25% of the formal jobs. Our debt to GDP is going to go from around about 30% to close to 40%. These are the government's MTBPS numbers. So the incentive for them to actually put a lid on wage growth rate is quite high. Yeah. Under that kind of circumstance, if you go back a couple of years, 15 odd percent, going to maybe 6%, that's their goal. I mean, we think it's probably going to be a little bit higher than that, but you're looking at 1/3, and that is a big driver of the disposable income for your consumer. So you take away that tailwind, and whether it's now, whether it's 3 months, whether it's 6 months, we certainly expect that tailwind to go. Obviously then the inflation, the other side of the coin, is going to be picking up. And the final point I would make on that is that by our analysis, the inflation of that upper income consumer might be 2 to 3 percentage points higher than the 6% officially reported. So that sort of jaws just tightens up for that upper income
And of course,
consumer.
then what comes under scrutiny is the quality of the kind of consumer spending we're seeing driving the consumer recovery, because we've seen this spike higher in unsecured lending, for example, and that is a lending usually that's one of last resort because of the high interest rate costs that are associated with it.
That too. I mean, even that started to roll over. Now it's not negative, it's still growing quite strongly, but it's off a high base. And it's slowing down. So that underlying spend is certainly going to slow. I mean, we were looking at something today where you look at the retail spend, the totality of the retail revenues versus, wages and social grants together. You go back to 2002, that was 16%. Up to 2008, it grew to 22%. It's been flat for the last 3 years. So if we do some simple maths and say, well, let's say the next couple of years that we grow wages by, say, 9%, about 3 reals, say, social grants around about the same kind of ballpark, you're not going to grow retail sales in totality by more than sort of 10%. If you get jobs growth, I mean, our base case is that there's no jobs growth, in fact, jobs contraction, but that would add 1% to it. Now, remember the last couple of years in totality, we've been seeing 13, 14, 15%. To go to 10, we're not sure that buy-side consensus is there already yet, but we're putting a bit of a cap on what you can grow. And obviously there's certain stocks that are going to win out of that, certain are going to lose, but the sector in totality is going to have a bit of a slowdown.
So in essence then, take us through your view on the economic growth story that South Africa is possibly going to put on the table moving into 2012, because where you've got this consumption recovery standing at risk and the production side of the economy not picking up just yet, one would assume it's a pretty fragile situation you're tabling in.
It is. The one area where there's risk, and obviously it plays into our one sector that we quite like, is construction, and that's mainly valuation, and we're seeing sort of bottoming out of cement sales and growth. So we think it's a time to have a look at it. Now, I mean, the key risk that we have is that with our zero jobs growth for the full year, is that effectively politics is going to play a big part this year. You've got the ANC policy conference in May, which I would estimate, jobs is going to be a key issue on the agenda. And in our mind, construction jobs are easy to create. So there is a possibility that can increase. But just to put it in simple maths again, 100,000 jobs gives you an extra 1%. So our 10% might grow to 11%. So it doesn't change our overall view of the retail sector being an area where we are cautious. But any kind of jobs growth that are politically inspired we would see that would play into something like the construction sector.
Within that construction space, so you've got your eye specifically on Murray & Roberts because of the disconnect that presents itself between the order book and the share price itself. Run us through the investment case presented by Murray & Roberts.
I mean, we have an interesting sort of analysis in our company, is that as a strategist, I like the sector, but our analyst particularly likes Avenge over Murray & Roberts, given the fact that there's a bit more risk in Murray & Roberts. So he prefers that. But having said that, he did some work, Roy Campbell did some work for us, that shows that if Murray's gets 30% of Gautrain, 30% of GP MOF, they could actually get R8 in free cash flow in 1 year. So that's almost 30% of their share price. So it's just giving you the indication that the valuations are pretty low, and if you're buying into the construction recovery, you might want to play the geared play, although as a house, we prefer Avenge.
You've highlighted that one of the draw cards to the construction sector is valuations, in essence, that we've pretty much bottomed out within that cycle and possibly recovery to tick in this year. Just how hard is it to find pockets of value in the local market right now? Because, I mean, you know, we've got traders out there saying, when you're looking at the valuations, you've got the bad news priced in. But to what extent, if we're seeing the local bourse hitting all-time high after all-time high at the start of a new year?
Sure, but Alishia, you know, got to look at it. I mean, the bourse is sort of priced nominally, effectively. So you go back to 2008, that was the last time we did it. You know, our earnings over the past couple of years are probably 50% higher. You know, it's around about that area. So our rating has come down significantly. 2 years ago, we were on a trailing 17 times, now we're on a trailing 13 times. So the absolute level is probably less of an issue than the rating the market applies to it. What is interesting for us is, even though we believe that the market returns are going to be about 10% this year, so below trend, the fact that we're sitting very close to long-term averages means that you can have these rapid, what we would call bear market rallies, which gives you very good returns, and then obviously that peters out later in the year. So, you know, indeed our own view was we went a lot more neutral on issues as at the end of December, given the fact that these bear market rallies can come in. So we prefer something like healthcare and the construction sector, where we can actually see the underlying drivers behind those sectors, rather than taking, you know, beta bets on the whole market.
So take us through your view on resources, because you know, where the construction and the healthcare space possibly stands, you know, in dispute right now, there's broad consensus that there is value to be found within the resources segment of the local bourse.
Look, we split it into, you know, I guess we're probably consensus. We like Anglo and Billiton, but we are very short on Sasol, and our view is primarily predicated on the oil price. We think the oil price is too high. I think you saw the IEA data came out yesterday that showed oil demand was negative for Q4 last year. So we think geopolitical risks are holding up the oil price, and once investors look through that, the underlying demand, you know, oil demand has got a beta of about 1.1, 1.2 to global GDP. If you disappoint in Europe, as we expect, the US is slowly grinding out a recovery. But, you know, globally, if your global GDP, as the IMF says, could come in the lower sort of upper 2% handle, you could see sort of negative demand growth in oil, which obviously impacts the oil price and then will obviously impact on our Sasol. So our big calls: underweight oil, you know, overweight Anglo Billiton, overweight healthcare, overweight construction.
It's interesting that you've got Sasol in that bunch, because many of the South African fund managers say it's a must in your portfolio. You've got to have it, and you know, yes, it's you know, prone to the risks associated with that oil price and the volatility we see there, and on the currency front as well. But you can't ignore the kind of intellectual property a company like Sasol boasts.
You're absolutely right. But I mean, you know, things like you know, the gas to liquids is quite far out. And at the moment, they're doing quite well because the spread between gas and oil prices is exceedingly high at this point in time. If you, excuse me, if you normalize that, perhaps the kind of margin that has been forecast is not going to actually be there. And then secondly, you know, as a rand hedge, the analysis that we've done, the best rand hedge is BAT, you know, BTI listed on our exchange. So if you're worried about the rand, that's the stock to buy, less the Sasol.
Okay, so that's one tip that you've put out for our viewers out there. What about within the financial arena? Because we've seen yesterday the banking index really do well, and that on the back of the kind of sentiment that's about globally, where we saw US banks' earnings come in better than expected for the most part, at least. Look,
I mean, our bank sector is probably not fantastically cheap or fantastically expensive. And I guess, you know, the beta to the global market is high. So we spent the last 6 months of last year, you know, taking a lot of pain globally on banks, although the SA banks actually did quite well. They outperformed the index. And so we've seen some analysis that's just showing that as the European banks withdraw from the financing because of Basel III and their deleveraging, you're finding that the Asian banks are coming in. So some of that negative sentiment is coming out. Problem for us, though, is that banks are still exposed to the upper end consumer. And even though they're deriving a lot of their income from fees now, with mortgage advances growth 0.7% year on year, it's not a great environment.
That, Vaughan, within South Africa, but a third theme that RMB has picked up for South African companies and that cannot be ignored is African expansion by South African listed companies. And that's certainly something that our South African banks are pursuing a little bit more aggressively. We've seen Standard Bank leading the charge, but others starting to play catch up very quickly.
You're quite right, but again, if you want exposure, there are companies with higher exposures to Africa. MTN springs to mind. The bulk of its EBITDA comes from Nigeria. But again, even though we're overweight on MTN in our model portfolio, our analyst Peter is more careful because we put out a big piece that is going to show going forward the competition we expect to see from Bharti is going to be an issue. So also exposed to Nigeria. If oil prices come off, unfortunately, MTN becomes a bit of an oil player as well.